Thanks for clicking. Large-scale mortgage relief programs can help to amplify an economic recovery, support house prices, and reduce the foreclosure rate. This according to a recent working paper coming from the Bank of Canada.
What the f***?
Yeah. While the Canadian real estate market has been described as one of the biggest housing bubbles of all time, sitting on top of a major credit bubble, and most at risk of spiraling into a bigger crisis, the paper from the Bank of Canada looks to study the options available to policymakers should that bubble burst, should Canada undergo a severe economic downturn, coupled with a bursting housing bubble. Now, granted, this is a staff working paper, and the bank is quick to note that it may not represent the views of the Bank of Canada, but staff working papers have a way of working their way into Bank of Canada policies, should the bank ever deem them necessary. Given that the debt loads of Canadians are rising while the real estate market shows major signs of a slowdown, financial stresses are growing, and it looks like the bank could be raising rates again at its next announcement, I think it's worth looking at the options being studied by the Bank of Canada should a severe downturn ever occur. Not that it necessarily will. So what I want to do today is go over the Bank of Canada study, taking a look at the options available to the government if a major housing bubble downturn did occur, look at some problems with the study, and then discuss what to look for next. Speaking of next, we have a big couple of weeks coming up with the release of Canada's national real estate data coming out some point in time next week, and Canada's inflation data coming out the week after. We will have an update out on both on this channel. Click like and subscribe if you want to get those updates, but for now, let's get into this paper. Onto the study. The paper looks to add to existing research that came out of the global financial crisis that found that high leverage, meaning high debt, can exacerbate an economic downturn or slow its recovery. So, too much debt can make a downturn even worse, and having to service that debt can hamper an economy's ability to recover. The paper looks to expand on this research by looking at debt relief options available to governments. Debt relief options that will A, mitigate the downturn, and B, accelerate the recovery. Now, before delving into the meat of the study, let's just get the politics of this out of the way, as, admittedly, this would be a highly contentious program were it to ever come to fruition.
Nobody put a gun to anybody's head and said, hey, Nimrod, buy a house you can't afford. You know what? While you're at it, put a line of credit on that baby and buy yourself a boat. The king ordered it!
But, regardless of the politics, the bank is studying if debt relief measures, if mortgage relief, could help stop a snowballing housing crisis and help revive the economy. To accomplish this, the paper starts by building a mathematical model of a hypothetical economy, similar to the US. I'm not going to pretend that I understand every line of this model, but the salient point is that the author is developing an economy which undergoes an 8% reduction in house prices, undergoes a recession, and the government doesn't do anything about it. The study then presents an alternative model where house prices drop by 5% and the government intervenes. The government provides mortgage relief, so all households that have loan-to-values higher than 95% receive debt relief. Receive debt relief until their loan-to-value gets below 95. So if you owed $95,000 on your house that was worth $100,000 and the value drops down to $95,000, the government intervenes, paying down your mortgage to $90,000, bringing your loan-to-value back to 95. So your house is worth $95,000, but you only owe $90,000 on it. Under this model, the paper finds that once the house is brought back down to 95 loan-to-value, there is an immediate stimulus to the economy, as households no longer have as much to pay in interest going to the bank. Instead, that money goes out to the economy, providing stimulus out there floating around.
Sounds familiar.
And viewers are going to no doubt love this. The study also found that stimulus would be ongoing, as homeowners eventually refinanced, took out that newfound liquidity, and that liquidity entered into the economy. So, under this model, the government provides mortgage relief, borrowers have extra money to go out there and spend, then, a few years later, can refinance their home, and again, have more money to go out there and spend.
Downside.
So, this model is basically cash injections coming from the government, but it's only for those who are currently underwater. Only for those who owe more on their home than it is worth. And finally, your tax money at work. The study also found that if you reduce the number of financially distressed households, you'll also reduce the number of foreclosures. And by reducing the number of foreclosures coming to the market, you will reduce the supply of houses coming to the market, and that should help prop house prices back up. So, in summary, the study from the Bank of Canada found that if it ever does hit the fan, if we do see a massive major house price correction, the government can intervene, reducing the amount of mortgage principal that is owed, which will A, help to stimulate the economy, both immediately and longer term, and B, will prevent a snowballing of house price reductions. Now, Obviously, the study is not without its issues. Most obviously, that it only looks at a 5% reduction in house prices, when, here in Canada, we've already seen a 17% reduction in house prices from February of 2022 to March of 2023. So we've already surpassed that 5%. With that said, the conclusions stemming from the bailout, stemming from bringing all mortgages back up to a maximum of 95 loan to value, and the potential stimulus provided to the economy thereafter, would still hold. The second problem, the study calls for these bailouts to be funded by debt, followed by future tax increases.
Oh, you.
And on this, the environment matters. If the CPI is back down to target, if the CPI is down at 2%, then it would be possible for the Bank of Canada to finance this operation, to finance this bailout vis-a-vis quantitative easing. On the other hand, if inflation is still high and the government had to go to the bond market to get the money, they could have a real problem financing this bailout at 5%, maybe even higher interest. And finally, one of the biggest problems with this study is that it's all based off of a mathematical model. There's no real-world cases that are actually studied. No real-world cases that will say the government tried X and Y happened. But on that, there isn't a whole lot of real-world cases available which match our current predicament, a post-pandemic real estate crash brought on by a higher cost of borrowing, induced by the inflationary environment caused by 0% interest rates. There just isn't a lot of cases out there that match that situation.
Give it some time.
In fact, the closest real-world case that we have to compare is 2008 US in the aftermath of the global financial crisis, when they tried the Home Affordable Modification Program. Under this program, the principal amount of mortgage owing was forgiven until the monthly payment fell below 31% of income, or the LTV dropped to 115%. And under this program, borrowers still owed 15% more on the home than it was actually worth.
Those are rookie numbers in this racket.
The program was riddled with problems and didn't help out as many people as they had initially hoped. And the key difference between the real-world program that the US tried and the one proposed by the BOC is that under the one from the BOC, homes are no longer underwater. Borrowers owe less than the home is worth, which, says the study, can help stop foreclosures and dampen the speed at which house prices lose their value. But other than 2008 US, there aren't a whole lot of debt relief programs out there which the government can study to see what would happen if the government did intervene under a housing crisis. As such, the bank is resorting to mathematical models which will be accurate to one degree or another. Now, all of this isn't to say that a meltdown is going to occur, that a major real estate crisis is going to occur, but I think the key takeaway from this study is that the bank is studying the options available were that to actually happen. Were we actually to see a major reduction in real estate prices, were it to hit the fan, and we started to see mass foreclosures, we're getting an idea of what policy options the government would be considering. If real estate prices start to tank when inflation is still high, and as such the Bank of Canada can't lower rates, the bank can't resort to quantitative easing as they would have in the past, then major mortgage debt relief options may be the next rabbit that it pulls out of its hat. With that said, we will continue to track Canada's real estate market and how this all unfolds on this channel. Click like and subscribe if you want to get those updates, but for now, thanks so much for watching.